The Dow Jones Industrial Average dropped 1,100 points for its biggest decline since 2020, and this marks the fifth day out of 2020 so far that we have seen over an 800-point decline in the Dow Jones Industrial Average. Now, exactly what is going on? Because you have consumer staples, consumer discretionaries, you have basically every sector of the stock market that sold off in a very dramatic way. The Dow was down about 3.5%. S&P down over 4% on the day. The Nasdaq down 4.73%, and the Russell 2000 down about 3.5% as well. There was nowhere to hide in today's sell-off. So I want to go over really what is happening today, why this is happening, how long this could last, if we're going to hit new lows, in my personal opinion, obviously, and get into all of the information that you guys need to know. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Most importantly, if you guys want to get yourself those free stocks with Webull, Moomoo, and Public down below in the description, check that out. Not a bad time to get yourself those free stocks considering everything seems to be on sale right now. So what is actually happening today and what is causing this? It's going to be earnings, and it's earnings from companies you would not expect to drop the markets, 4.5% or 4% on the S&P, almost 5% on the Nasdaq. These kind of earnings you wouldn't think would do this, but really one of the biggest upsets to earnings today was Target. They dropped over 25% after the company says high cost inventory woes hit profits. The key points: Target shares dropped sharply on Wednesday after the company said its quarterly profits got hit by supply chain troubles, higher fuel costs, and lower than expected sales of discretionary merchandise. Discretionary is like you can choose, right? Like an iPhone would be discretionary compared to a $200 phone, right? You would say a phone is pretty essential. That's a staple. You need some level of communication in your life for the most part, but some things are discretionary versus not. And you're seeing major retailers saying, hey, not only are we seeing gas prices going up, we're seeing inflation hurting our bottom lines a lot, our profit margins, but you're also seeing these same businesses saying, hey, people are just spending less money, that they're not buying as many discretionary products, and that is not good. And you're really starting to see more of this recession kind of fear starting to kick in. Now, this is also digestion, in my personal opinion, from what the Fed just said about 2 days ago. Essentially, or was that yesterday, 2 days? What? It all blends together. Essentially, what the Fed said was, we're probably going to see a recession. There's not too much we can do about it. We can't control supply chain inflation, supply chain issues, but we can bring down the demand, and basically pointed to the labor market saying, hey, for every one person that wants a job, there is 2 job openings. That's not good. So what Powell basically said is they have room to just raise rates as much as they want, even going past that neutral rate, which a lot of economists believe is in between 2.5% to 3%. So there's a lot of fears about the Fed raising rates so aggressive they put us into a recession. And then you're also seeing these major staple retailers, staple meaning a Target, a Walmart, a Home Depot, businesses you have to shop at, right? You have to get food, you have to get these products from these businesses that are not painting a pretty picture for the actual consumers or customers, which would be us, the American people, for the most part. So that's not good, and that really hit the markets in a very substantial way. Apple specifically did help to drive everything down today and really led the way for the most part. Apple dropped about 5.64% here in regular trading, down 0.17% here in after hours, and it wouldn't surprise me to continue to see more downside pressure over the next couple of days. Look at Cisco. They just reported earnings here in after hours, and they guided for a negative year-over-year growth rate, and they're down almost 16% here in after hours, and it's not looking so pretty. So you're just getting back-to-back bad earnings with lower guidance as well as lower profits, and that is not a good thing for the markets. On top of all of that, there's a lot of concerns about the price of oil, as it has been spiking and pretty much going crazy. Even in Michigan, it's almost to $5 a gallon for gasoline, for regular gas. It's getting out of control. And essentially, a lot of people are concerned because the higher oil goes, the greater likelihood you have of seeing a recession. I know if you were somebody that drives a lot, you're cutting back one way or the other because it is just so expensive to do things, to go anywhere. And the biggest traveling time of this summer season that we are heading into is from Memorial Day, which is right around the corner, all the way until the 4th of July. Then you start to usually see a downtick in the price of gas after the 4th of July, but obviously there's no guarantees this time around, and given the state of the energy markets and the way that it's just not getting better, there's nothing that is really changing here. If anything, things are getting worse, then you have a greater likelihood of going into recession because people are obviously needing to cut back on how much they travel. If you travel a lot, it's very expensive. It's 2 or 3 times more expensive this time this year than it was last year to do the same amount of driving or traveling. So people are definitely cutting back. Not good for the overall economy. And what you're seeing reflected with Target, Walmart, Lowe's, Home Depot, it's not painting a pretty picture, like I said, for the overall consumer. Now, on top of that, we are coming off of retail sales, which I thought would have been much better for the markets, because we had retail sales that were expected to come in at 1% yesterday. They came in at 0.9%, which was pretty much on expectation. So it was overall a small miss, but still really good. Like, it could have came in negative. It could have came in substantially lower. And that's why you did see a bullish reaction to that data. Yesterday, you also did have China saying that they're going to ease restrictions in Shanghai. And that was seen as a very bullish thing for the markets as well. But these new earnings are just destroying the markets. And it looks like a lot of major stocks, even the S&P, are taking bigger moves down here in after hours, down about 0.33% on the S&P 500, just here in after hours alone. Pretty substantial moves. We dropped $16.50 in the SPY today alone. The volatility is here, and we are going back down to the lower end ranges. Now, I will say there is not too much news for the rest of this week. We've talked about this a couple times. We might have some Fed speakers here and there throughout the week, but the only other real data points we have is real estate data. Other than that, there's really nothing that should move the markets unless we do get headlines from the Europe conflict or from COVID and China. Those things can come out of thin air essentially at any time and either help the markets a lot or hurt the markets a lot, but we don't really have any data for the United States specifically that should move the markets one way or the other. Now, at the same time, this might be a little bit of cause for concern as far as the markets are concerned, but you actually do have Turkey that rejected the SWIFT NATO approval for Finland and Sweden. So that could have some implications, if Russia were to really attack one of those other countries. I mean, you're talking like full on World War III if it has not already started, and that's obviously not going to be a good thing for the markets. Let's just call it that. After all, this is the worst start to the year in the stock market that we have seen since 1939. And what started in 1939? Well, World War II. So a couple things to keep in mind here. It doesn't look like there's an easy fix to any of this, but that does not mean you could not see the markets go up, right? The markets are going to be very volatile. That's why it's very hard right now to actually trade the markets, because they could be up, 2 to 3.5% like they were yesterday, and now today they're down even more. We've given back all of the gains from yesterday plus some. So that's why it's so hard to trade this market. I truly think this is the greatest wealth creation period that we could hope for a very long time. I think once the markets come out of this downturn and things go back to normal, whatever normal is at the time, I think the markets are going to be in a much stronger and much healthier place, and this could be the buying opportunity of a lifetime. And it could be longer lasting. It could be a year or two, and this will give you time to load up on your favorite stocks and build out big positions to inevitably ride the wave once we do ultimately go back up. So let's get into some of the other information we need to cover here in this video, like what specifically happened with AMC stock. Now, AMC was very interesting today because the stock was up almost 10% at one point today after it initially, during the first couple of minutes of trading, did sell off a little bit down to $12.51 per share. We quickly rebounded all the way up to $14.20 at the high. Shout out, you see the 420 in here. Look at those trading algorithms trying to play with us. We had 1420 on the high, came down, came back up, tried to retest the high, got rejected, and sold off pretty much ever since then, and then kind of plateaued once we were down about 1% on the day. And that's what we closed down, 1.09%. In after hours, you are down 0.71%, but by and large, when you're looking at a 4% down day on the S&P, almost 5% down day on the NASDAQ, almost a 4% down day on the Russell 2000, all things considered, if AMC fell 1%, that is a win on the day in my personal opinion. Now, I had some people comment on the last video, like, don't you want to see the markets fall to get the MOAS? And yes, but that's not going to cause the MOAS. You need some level of catalyst. It might be this executive order. It truly and honestly could be executive order 14032 that does go into effect around June 2nd, June 3rd, that could trigger the MOAS. And it would not surprise me to see a lot of bullish activity in the couple of weeks up until June 2nd or June 3rd, which we're kind of in that phase right now. We have about 2.5 weeks until June 2nd and June 3rd comes around. So I do expect some bullish activity here, for AMC stock over the next couple of weeks, considering the markets were down so much today. They're down in after hours as well. Cisco earnings, like I said, it's not going to help anything, but I do think, considering this drop, that we might just ping pong back and forth for a while, and AMC could trend to the upside as the markets are trying to find a solid footing, because with everything going on, the markets have priced in a lot. QQQ year to date. Let's see what it's down year to date, just for shits and giggles here. QQQ. Google, load the QQQ. It's down 27.5%. So you've priced in a lot of bad news. A lot of stocks, say if the average stock is down 27.5%, some stocks are down much more than that. Some stocks in the NASDAQ 100, which is the QQQ, 100 of the largest tech companies, not even like all companies. These are the 100 largest. These are not your small companies here. Some of them are down 60, 70, 80% in the NASDAQ 100. So you've seen a lot of pain, and we can get all the bad consumer news that we get, all of that. But until you really see earnings substantially come down in a big way, then I don't think you're going to see like a 50% down NASDAQ. Now, we did get those bad earnings today, not necessarily like your NASDAQ companies. Some earnings were better than others. Lowe's and Home Depot were better than what a lot of people expected. Something like Walmart and Target, not so good. So a little bit of two different realms right there. Lowe's and Home Depot obviously don't really focus on the same things that Target and Walmart focus on. And this is just overall not good news as far as how the consumer is doing, but it's really a mixed bag. Banks, the last earnings, they said, yeah, consumers are fine. They are spending. Visa and MasterCard had great things to say. The bank said, yeah, we still have record savings in accounts, so on and so forth, but these retailers are telling us a different story. So until we see one side hash it out and come to a definitive conclusion of, is the consumer doing good or bad? Like, there's so many different things you could point at that, one side says yes, one side says no. It's like you don't really have that melting point. Now, I do think the markets are one catalyst away from either seeing a major meltdown or a major rip to the upside. Looks like more so a major meltdown at this point, granted. Most of the market is really propped up still by Apple. If Apple continues to have these substantially red days and continues to sell off further, that's not going to be a good thing. And you're really at this 140 level that is very critical. If we fall under 140, 120 could definitely be in the cards here very shortly for Apple, and that would push the whole markets well into bear market territory. That would probably push the NASDAQ down almost 40% year to date. This is a very dramatic sell-off that we have been seeing. But overall, even all of that considered, I still think AMC stock is going to be relatively bullish over the next couple of weeks, considering what we've seen in the past with this executive order. Now, let's go ahead and take a look at the option activity. Let's see what the hedgies are doing with their option trades. And you're seeing a lot of puts coming through. A lot of puts for May 27th. That'll be next week. Look at them. 13, 13, 13, 1350 puts. A couple 13 strike calls. But when they're buying these $13 puts, their break even is so small that it causes a lot of that artificial shorting, and that's definitely what you are seeing today, especially during the last half of the day today. You're definitely seeing a lot of those puts coming through and a lot of market makers shorting. Now, as far as the interesting flow sentiment, you're looking at 19 orders totaling $980.39 thousand, positive order value of 44% for the day. So it's somewhat a neutral day, but it definitely looks like there's a lot more put activity on AMC stock. Look at the short interest. Again, more borrowed shares than return shares. 5.05 million borrowed shares, return shares at 3.71 million. Current short interest of free float about 22%. More specifically, at 21.99%. You are seeing the shares that are sold short of 113.34 million. Cost of our max of 4.33%. The utilization is at 100% and days to cover sitting at 3.21. So, that are not looking so good here, okay? It's not looking so good for the hedge funds, but it's exactly what we should expect to see given what the markets are currently doing. And if we do look at the option activity, what's actually on the option chain, we still have 2 days left, so we could set up for quote unquote a mega bounce, as I like to call them. When you get down to Thursday and Friday, if a lot of calls start to go into the money or a lot of puts start to go out of the money, that's a lot of potential buying power that the market makers have to essentially hedge out in 1 or 2 days time. That can cause dramatic moves, like 20% moves on a Thursday or Friday, based off a lot of options that are on the option chain. And that's exactly what you're seeing. About 27,000 calls that are in the money, 257,000 calls that are out of the money, for puts that are in the money at 90,000, puts that are out of the money at 97,000. So a lot of potential buying power could, head into AMC stock if markets do trend upwards, or if AMC stock can trend upwards as well. I think AMC would have honestly been substantially positive today if the markets could have actually held up, but it's very hard for AMC to remain positive when markets are down their biggest day since 2020 over the past 2 years. You guys got to realize that. The fact that AMC only fell 1%, very, very bullish. Do not think for a second that is not bullish. So that is going to be all for this video. That's what you guys need to know. That's really what's going on in the markets today, and what I kind of expect for the markets in a whole and for AMC stock. I think there could be a little bit of a disconnect here where AMC does start to perform a little bit better than the broad markets, but if the markets have 4 or 5% down days, you got to throw your hands up. There's nothing you could do there. There's no buying power that's going to help that. There's too much shorting at that point. So that is it. You guys get your free stocks down below in the description of this video with Webull, Moomoo, and Public, as well as that. If you guys want to come trade with me live in real time, link down below in the pinned comment. You guys enjoy the rest of your day, and I will see you in the next one.